สวัสดีค่ะท่านผู้มีเกียรติทุกท่านนะคะขอต้อนรับทุกท่านค่ะเข้าสู่หลักสูตรอบรม Common Issues in Early Stage Fundraising นะคะโดยครั้งนี้ค่ะเป็นครั้งที่ 4 แล้วนะคะเราจะมาคุยกันในหัวข้อ Striking a Win-Win Deal with CVC เลือก CVC อย่างไรให้ Win-Win นะคะซึ่งในครั้งนี้ค่ะเราลองมาฟังมุมมองของคุณดักลาสกันนะคะว่าที่เรามองว่าการร่วมทุนในรูปแบบของ CVC กับ VC นั้นต่างกันเนี่ยคุณดักลาสมองว่าต่างกันในประเด็นไหนบ้างนะคะการที่เราจะต้องระมัดระวังหรือว่า red flag ต่างๆนะคะมีส่วนไหนที่คุณดักลาสมองว่าเป็นจุดสำคัญเลยและที่สำคัญคือดีลที่ดีนะคะมีรูปร่างหน้าตาเป็นแบบไหนค่ะโครงการอบรมในครั้งนี้นะคะเกิดขึ้นจากความร่วมมือระหว่างตลาดหลักทรัพย์แห่งประเทศไทยโดยห้องเรียนผู้ประกอบการค่ะและ Expara ประเทศไทยนะคะดำเนินการภายใต้โครงการการรับมือและฟื้นฟูธุรกิจอย่างเร่งด่วนดำเนินการโดย Youth Business International และได้รับการสนับสนุนจาก google.org ค่ะซึ่งโครงการอบรมสนับสนุนผู้ประกอบการนี้นะคะก็จะดำเนินการอย่างต่อเนื่องเลยไปถึงเดือนเมษายนนี้ค่ะในวันนี้นะคะเราจะใช้เวลากับคุณดักลาสค่ะเหมือนเดิมนะคะก็จะใช้เวลากับประมาณเกือบ1 ชั่วโมงนะคะที่จะฟังคุณดักลาสบรรยายนะคะในหัวข้อ Striking a Win-Win Deal with CVCs นะคะจากนั้นค่ะเราก็จะเผื่อเวลาไว้สำหรับช่วงเวลาถามตอบนะคะ20 นาทีในช่วงท้ายของการบรรยายนะคะก็จะมีการสรุปการบรรยายรวมตอบแบบสอบถามนะคะเพื่อรับเอกสารประกอบการบรรยายและสิทธิพิเศษในการเข้าร่วมกิจกรรมอื่นๆของโครงการค่ะเอาละค่ะและในวันนี้นะคะในลำดับถัดไปค่ะดิฉันก็จะขออนุญาตเรียนเชิญให้ทุกท่านได้พบกับคุณดักลาสนะคะดักลาส Abrams Founder and CEO of Expara ค่ะ
Okay, good evening, everybody, and thanks for joining. I want to leave as much time for question and answer as possible. So feel free to type questions into the chat while we're or the Q&A. So you can type questions into Q&A or chat while I'm talking, and I'll if I get questions during the presentation time, I'll try to answer them, and if there's no time, I'll answer all at the end, and I'll also try to carve out some time at the end of the session specifically for question and answer. So I'm sure everybody has a lot of questions on this topic. So my topic tonight, it's called Doing Win-Win Deals with CVCs, which means doing win-win deals between CVCs and startups. So I think this is especially relevant. This is an especially relevant issue for our market because in Thailand, CVCs are among some of the most active venture capital investors in the market. If you look at other venture markets, for example, like in the US, something like the CVCs are doing about 20% of the total VC investment, and financial VCs are doing 80%. Now, we don't have real data from Thailand, or I don't have real data from Thailand to justify this, but my guess would be we probably see the reverse in the Thai market. I think I would guess that estimate that CVCs are probably doing 80% of the venture capital investment in Thailand and financial VCs 20%. Definitely when you look on a just anecdotal basis, you see most of the big deals in Thailand, or many of the big deals in Thailand, are being invested by CVCs, either CVCs leading the deals or participating in the deals. So I think this is a very interesting aspect of the Thai startup and venture capital market, that some of our most active investors are CVCs, and that probably CVCs are a bigger percentage of the market than financial VCs. Whether that's going to continue, it's not clear, but I think it's definitely the landscape that we find ourselves in now. And therefore, everybody in the market, including obviously CVCs, startups, and financial VCs, need to think about the consequences of this for the venture market. Most of the best practices and most of what we know about doing good deals between startups and VCs comes from financial VCs, the deals between financial VCs and startups. And there are plenty of overlaps and similarities between financial VCs and CVCs, but there are definitely significant differences. And tonight I'll focus a little bit more on the differences and try to help participants to understand and get a feeling for what are the added complexities and challenges that come into play when startups meet CVCs. So I like to start off by talking about the difference between CVC and VC. Now, of course, CVC is also VC. So the difference, the way I like to distinguish is traditional VC, we could call financial VC. Corporate VC is corporate VC. And what is the fundamental difference? Now, I like to say, venture capital is hard, but CVC is harder. And why do I say that? Venture capital investment, I believe that venture capital investment is the most difficult form of investment in investment markets. And how do I justify that statement is if you look at the success rates of VC investments, they're very low compared to other types of investing, meaning in a typical, even in the highest risk equity, traditional equity investment portfolio, you're going to see a normal distribution, relatively normal distribution of returns. Even in hedge fund investment strategies and even private equity investment strategies, which are the next riskiest and most difficult, therefore, forms of investment, you don't see the very extreme risk return profile that you see in venture capital. So some of you have probably seen my other presentations where I talk about success and failure rates for VC investments, but my data on this is something like 75% of venture capital investments fail to return invested capital, with 50% resulting in total losses. And there's no other investment category or asset category that even comes close to that in terms of the risk in the investment. Now, returns are also higher than every other asset class. So if you think about investment strategy that requires you to take very high risk to generate very high returns, this is in one sense, meaning one very meaningful sense, the hardest type of investment. So that's regular VC. But if you look at the regular VC bar, so here I call financial VC. So what do financial VCs need to do? They need to do two things. So they need, fundamentally, they need to deliver sufficient financial return for their investors to be happy, which is something like 20 to 30% a year net of fees over approximately 10 years for each venture fund. And in order to do that, they need to add differentiated value for startups, because in order for VCs to be successful, they have to source high quality proprietary deal flow. They have to do good deals with those startups that they get through their high quality proprietary deal flow. They have to support those startups through the post-investment phase, and they have to help or enable the startups to exit successfully. So that's what I call add differentiated value for startups. VCs that don't do that will not be able to generate sufficient financial return. So that's what makes this, those are the two things that make this business so hard. CVCs have to do the first two. So they have to do exactly the same as financial VCs, but they have to do a third thing, which is generate strategic returns. So what does that mean? If as a financial VC, I only have one challenge. I just have to deliver sufficient financial return to the investors in my fund. If I do that, I succeed. If I fail to do that, I fail. And I have a very clear and focused mission. It's a difficult mission, but it's clear and focused. As a CVC, I have that mission, but I also have a second mission, which is to generate strategic return for my parent company. Now, what's the difference between financial VC and CVC? Financial VC is invested in by financial investors who are looking just solely for financial return. CVC is invested by a company who is looking for both financial and strategic return. And this adds a tremendous degree of additional complexity to the mission of CVCs. And this additional complexity is also going to have many ramifications when we look at the relationship between CVC and startup. So if the CVC fails to deliver financial return, they fail. But they can also fail because they deliver financial return but don't deliver strategic return. And the picture is even more complicated and even more difficult, as we're going to see in a minute, because there can be inherent conflicts between strategic and financial return. So underneath the bars, we can see, in addition to this bifurcated mission, which makes CVC very difficult or even more difficult than financial VC, if the CVC does not differentiate and does not do good deals, they're also going to fail because they won't get into the best investments. And we can see the added difficulty of CVC has been illustrated in historical failure rates for CVC programs. So the median duration of CVCs historically was about 4 years, with almost half investing actively for 3 years or less, and only about 1/4 operating more than 10 years. So for a successful venture capital fund, usually you have to run at least 8 to 10 years. So the good news is, although these success rates are a little bleak, but they used to be even worse. So median duration of CVC previously was around 1 year. So that's improved a lot. And these statistics are are from the US. So they're not looking at Thailand. And it'll be very interesting for us to see, how does CVC fare in Thailand and Southeast Asia versus how has it fared in other markets? And what are some other fundamental challenges that CVCs have? There are some historical issues between CVCs, founders, and financial VCs. Now, again, this is not as much in the Thai market because CVCs are relatively new here. But these also point to long-term difficulties that we may see in our market in the relationship between CVC and financial VC. So, for example, there are some prominent founders in startup founders, not again in Thailand, but in other markets, and prominent VCs who said they'll never take money from a CVC or never co-invest with CVC. Traditionally, entrepreneurs' dream is not to raise money from a CVC, but from a tier one, brand name VC. Now, again, this is somewhat different in our market because our CVCs most of our CVCs have a good brand, but we'll have to see how that ages over time. And from the other perspective, looking at it the other way, as a CVC looking at deals, the startups that the CVC wants to invest in may not instinctively want those investors. So we can see potential matching problems on both sides of the CVC and startup aisle. So this is one very well-known example of very well-known VC. So Fred Wilson, he's a managing partner of Union Square Ventures, which is a company that invested in Twitter, Tumblr, Foursquare, Kickstarter. He's a very successful and popular VC blogger, and he hates CVCs. I have there's a video clip that I sometimes play along with this presentation where Fred Wilson, in this interview we're looking at here, he says, CVCs are the devil. And I mean, I think he's just trying to make a point, but what you can see from his quote here, he is a total non-believer in the viability or validity of CVC. Now, I don't share this view, and I've worked with many of the CVCs in Thailand, both when they first started and even till today. In our Thai fund, we have investment from GSB and SET, which makes us in some sense a CVC because we're invested by a company or two companies, and we have some strategic goals, and we also have done co-investments with most of the major CVCs in Thailand. So I don't personally harbor this view at all. I feel in our market, CVCs don't have a reputation like this. But what I want to think about in our program tonight is how do we, what has caused these type of attitudes in other markets where CVCs have been operating a lot longer, and how do we make sure that that doesn't happen here? So how do we make sure that in our market, CVCs don't get the bad reputation that they have, for example, in the U.S. market, or that they have with some key players in the U.S. market? Now, the primary and the most important challenges that CVCs face is in what I call alignment of interest. And the alignment of interest issues that CVCs face are very important in informing the deal terms and deal structures that they like to use. So the first alignment of interest problem that we see with CVCs is strategic versus financial returns. So if you are looking at the corporate venture capital from the CVC side, how do you balance your strategic return requirements with your financial return requirements? Should you look at financial return hurdles first or strategic return hurdles first? When you're considering particular deals, should you screen out all deals that don't meet your financial requirement and then look at the strategic value, or vice versa? And there's no right or wrong or easy answer to this. There are also there can be inherent conflicts between strategic and financial returns, which will affect deal terms, and which we're going to explore in more detail in a couple of minutes. Startup versus corporate. So we have clash of culture. When we're CVC investing in a startup, we immediately have potential for corporate culture clash, because startup culture and corporate culture are very different. One very common example is the concept of time. So time within your corporate is very different from time within your startup. What does it mean? In a corporate, maybe let's say it takes us 3 weeks to turn around changes on a term sheet. And we think 3 weeks to turn around changes on a term sheet is very fast. In a startup, they feel like 3 weeks to turn around changes in term sheet is forever. they want to turn around changes in a term sheet in 3 hours or 3 days. So the concept of how long things should take or going to take can be very different between startups and corporates. And that's just one example of the different culture, different environment, and how we do see frequent clashes between startup and corporate culture when CVCs are involved. CVCs versus financial VCs. So CVCs and financial VCs have some common interest in financial return, but they have a misalignment of interest in strategic return, because from a financial VC perspective, I just want to maximize my financial return from my investment in the startup. If this startup generating strategic return for the if the startup generates strategic return for the corporate VC without in any way diminishing my financial return, or even if the ability of the startup to deliver strategic return to the CVC enhances my financial return, that's great. In the case where the startup delivering strategic return for the CVC in any way reduces, limits, or endangers my financial return, then we're going to have a misalignment of interest and a conflict. And this is one of the most obvious root causes of the historical conflicts between CVCs and financial VCs. CVC versus corporate development. Corporate development in the parent company of the CVC is responsible for mergers and acquisitions, for acquiring companies who have strategic value for the parent. And this can become, at some level, I believe this is the most significant potential divergence of interest between startup and CVC. Later, I'll talk again in more detail about that. But fundamentally, VCs, including CVCs, make minority, non-controlling investments into startup companies. Corporate development buys companies. And when you're a VC, corporate development of a large strategic can be a great exit opportunity. But when you're a CVC and that corporate development is part of the same company as you, this can create very dangerous conflicts of interest between those two parts of the same company. And then CVC versus business unit. So the benefit of CVC for the startup and the real differentiated value that CVCs can add to most startups comes from their business units. When startups go to venture capital investors, I'm sure startups that are attending our class tonight, or startups that are reasonably sophisticated, when they talk to an investor, be it a financial VC or a corporate VC, I'm sure that one of the first questions that they ask is, what can you do for me besides give me money? Everybody needs money. Everybody who's talking to investors needs money or wants money, because that's why they're talking to investors. But money is a commodity. The money is the same no matter where you get it from. And good startups or highly popular startups, or startups that investors are interested in, will very often have their choice of VCs, and therefore they're going to always look at a VC who can add differentiated value, which isn't just going to come from money. Now, so if you think about what type of differentiated value can a financial VC offer, they can offer a lot, especially if they're a well-known, well-regarded, or tier one VC, because they have network, they have the capabilities inside their company, they have experience with startups, and they can share a wealth of knowledge and contacts and network, et cetera. But they can help with the business side, but only indirectly. The CVC, so this is where CVC can potentially shine, because the CVC, because they have a such a close relationship with a corporate parent, and especially if that corporate parent is a player in the startup sector, the CVC could potentially provide way more real differentiated value on the business side than any financial VC ever could. But the problem or challenge is that value, it's not going to be provided by the CVC itself. It's going to be provided by the business unit within the parent company. And this is why the aligning the interest of CVC and business unit within the parent company can also be very difficult and can also result in misalignment of interest. So let's look in more detail at some of the negative perceptions of CVC that have developed in other markets, which hopefully not going to take root in our market. So these are the things that people often, you hear entrepreneurs or investors say about CVCs, for example, in US market, that CVCs are the funding choice of last resort, meaning only startups that can't get money from financial VCs end up at CVCs. Or next one, CVC is just an extension of M&A looking for cheap buys. Now this is what I was talking about in the relationship between corporate development and CVC, because if CVC is really just looking for a cheap deal for their M&A department, that's a huge problem for startups. Now, one of the I think big misunderstandings that I see now, this one also happens in our market. Startups will get a pitch from a CVC, or they'll think that if they get investment from a CVC, it's great because the parent company of that CVC can also buy the startup. So they kill two birds with one stone. They get a VC, but they also line up their potential acquirer, which is the parent company of the CVC. This is totally wrong. The startup should never be targeting to be acquired by the parent company of a CVC that's invested in them. I mean, and why is that? Because exactly the issue that we see here. Once a CVC is a shareholder in the startup, then the parent company, corporate development, it's no longer really arm's length acquirer. There's bound to be some information flow between CVC and corporate development, which means that the corporate development part of the parent is never going to pay top dollar for the CVC, for the startup. And I mean, especially if they have some special acquisition rights, which we're going to talk about later. But this is not to say that a startup invested by a CVC should never be acquired by the parent, but they should only be acquired in the case where there's an open market for acquisition and the parent of the CVC is the one that's willing to offer the best deal. And some CVCs have engaged in the search and copy, search and destroy missions, or even the next one, deliberately creating financial distress. So I never saw this in Thailand, but I have definitely seen, heard about some US CVCs or European CVCs that make investments into potentially competitive startups with intention of removing them as competitors, and then maybe even acquiring them very cheaply after some underhanded activity. Again, I never saw this in the Thai market. I don't believe it happens here, but this is one of the risks in the CVC market that we want to avoid in the long run in our market. So next point, it's about, again, the conflict between the corporate development and CVC. So you think you're just getting an investment, but actually you really sold the company because corporate development is just going to buy you up later. Next thing, some characteristics of CVC investment tend to move slowly. Important decisions require approvals from BU heads or executive committee. And again, startups highly value speed. And in the startup world, we know that our markets develop at light speed, and we therefore have difficulty dealing with investors or shareholders who have very slow response cycles. And then again, some traditional rubs against about CVCs that they can't lead. So this will, again, we don't see that so much in the Thai market. Only invest in later stages. This never there when you needed them. Again, this is risk for CVC because a lot of CVCs don't want to do seed or pre-seed or pre-revenue. Now, that happens to be cross-market in Southeast Asia, though. So I think we see less of a difference here between financial VCs and CVCs. And again, third comment, something very similar, where in traditional CVC markets, they're usually operating at much later stages. So how do we avoid pitfalls of CVC investment? I highlighted in the first section a lot of areas where we have pitfalls. So a lot of potential for misalignment of interest, conflict of interest. So how do we avoid? What are some of the root causes of these potential conflicts? So I talked about some of these already. So we have the conflict between the risk-seeking nature of CVC and the process focus of most corporates. We talked about time as different meaning and how startups want to be fast and corporates tend to be slow. The standard big company commercial agreements. So the commercial agreements that the parent companies of CVCs are used to doing will many times not work well with startups. So we need the right we need the right structure, and we need more startup friendly commercial agreements. In the startup and venture capital ecosystem, we usually have sort of a give first attitude, where we try to help first and we then expect that there's going to be benefits in the long run. But this is a lot harder for major corporations to do. Another potential conflict, the CVC team ultimately cannot deliver on strategic value promised by the startup, promised to the startup. So why does that happen? Because the strategic value is delivered by the business unit, not the CVC. So the CVC can actually promise or can promise strategic benefits to the startup with the best of intention and fully sincerely, but later the business unit doesn't follow through, and this causes obviously bad situation for the startup and then bad reputation for that CVC, and which can also leak into reputation of CVC in general. So one piece of advice that I always give relevant to this question around this issue, the issue of let's say strategic value promise to startups. So I always think that we should keep every startups and VCs, including financial VCs and corporate VCs, we should always keep our commercial arrangements and our financial arrangements separate. And there shouldn't be quid pro quo between financial arrangement and commercial arrangement. Meaning what? You see a lot of deals. Now we do see a lot of deals in our market where there's two parts of the deal: a financial investment and a commercial agreement. And this can work as long as both are attractive on a standalone basis. So I always like to say to the startup, if you would not accept these commercial terms without the investment, you shouldn't accept the commercial terms with the investment. And the same thing on the investment side. If we wouldn't do this, if you would do this investment without the commercial terms, then you should do it. If you wouldn't do the investment without the commercial term, you shouldn't do it. So commercial terms and financial terms should always be kept completely separate from one another and should stand alone independently attractive in terms of their attractiveness. If you stick to that rule, you'll eliminate a lot of the potential problems that come from bad CVC startup deals. Another point that I would like to make about that, often another potential cause of conflict or bad CVC startup deal terms is the understanding that there'll be strategic value for the startup, but not included in any contract. So, for example, we do have an investment and shareholder agreement. Maybe we have some commercial agreement, but there is an expectation, especially from the startup side, based on conversations with the CVC, that there are going to be many other strategic benefits that are not included in the agreements. And I always like to say to startup and to CVC, everything that's not in the agreement, it's discounted to zero, meaning we should assign zero value to any expectation of strategic value that's not explicitly stated either in the investment agreements or in a real commercial agreement. So, okay, so these are, now this I think is what everybody really wants to hear. So these are some of the deal terms, specific deal structures that we need to avoid between startups and CVCs. And if we can avoid all of these, then we're going to have many fewer bad CVC startup deals. So our topic tonight is about doing good deals, and that starts here. So we need to avoid any terms in our investment or shareholder agreements that limit the ability of the company to do business with competitors of the parent of the CVC. And this is, I think, this is the first most common source of bad CVC startup deals. And you can understand where this comes from. It comes from the logic that the parent company owns and invested in this CVC. This CVC is investing in this startup because they want financial return, but also because they see strategic value from the CVC, and therefore they don't want the startup to give that same strategic value to their main competitors, because then they're in effect, shooting themselves in the foot. They put money into the CVC. The CV funds this startup because they're going to get good financial return and potential strategic return. But now their competitors get the exact same strategic return. So it seems like it's natural for CVCs to want to block the ability of the startups they invest in to do business with competitors of the CVC, but startups should never agree to this. Because why? Because if the startup should not limit their ability to do business with anyone, and that's not in the interest of the startup. It's not in the interest of the startup to limit who their customers are. And if the best potential customer for the startup is a competitor of the parent of the CVC, the startup should do that business anyway. Same thing, and even more important, is limit the range of acquirers or the pricing of an M&A. So meaning putting deal terms into the investment or shareholder agreements between CVC and startup that limit who the startup can sell to, again, usually competitor, and also limit any pricing of M&A, meaning try to agree or to carve out some preferential pricing for the parent of the CVC to acquire the startup. And again, founders should never agree to this, should never agree to limit who they can do business with or who they can sell to. And this is what, when Fred Wilson said this is a deal with the devil, that's what he meant. When startups limit their ability to do business with anybody they want, or they limit their ability to sell to anybody that they want, they have now effectively sold the company rather than got minority investment. And by the same token, CVCs should not insist on this. So CVCs should always invest in startups without requiring any of these limitations. This extends to negative blocking rights, things like ROFRs or ROFOs. So ROFR, right of first offer, right of first refusal, ROFO, right of first offer. These are usually, these are investment deal terms that give existing investors the right to block future funding rounds or even acquisitions. They normally require the investor to match the deal for that next round of investment or acquisition. And for financial VCs, you might be willing to give them ROFO. I'm not a big fan of that either, but you definitely don't want to give ROFO as a startup to any CVC. The right of first notification, maybe ROFN, maybe okay. It can be okay. You're going to notify the investor when this happens, but you should never give any sort of negative blocking right to a CVC, and CVs should not request or require negative blocking rights from startups. Startups must also always retain full 100% ownership of their IP. So this is another potential conflict area between startup and parent of CVC, because sometimes CVC might want to acquire IP in the startup for their parent. Again, startups must always retain full ownership of their intellectual property. Now, next problem that we need to avoid is that even when we don't have such restrictive deal terms in our investment agreements like the ones that I highlighted above, then we might find ourselves in a position where aligning with the corporate might alienate competitors of the corporate to do business with the startup. This is pretty hard to avoid if we're going to do deals between CVC and startup, but it's something that startups need to be aware of. We already talked about CVC interest not being aligned with financial VC interest. One other challenge that we need to keep in mind where CVC is different from financial VC is turnover in CVC team. So typically when startups get investment from financial VCs, there's a partner in the financial VC that's running the deal, and that partner is very likely to be with the financial VC for the life of the fund, because financial VC partners stay with their funds throughout that fund life. In CVC, because the partners in the CVC may be employees, then the team might experience turnover during the investment period that disrupts the continuity of their coverage. Okay, so let's go to doing good CVC deals. So I already started to talk about this, but what are some of the best practices in CVC deal terms? So the first and most important, I would say, go for normal VC deal terms. This means we shouldn't see any funny or non-standard terms in CVC deals with startups. And startups should also adopt the same position. If the CVC is suggesting any funny or off-market or non-standard terms in the investment or shareholder agreements, startups should not accept. And even some terms that you might be willing to accept in a financial VC, agreement should not be in CVC agreement. For example, I made very strong case in the previous slide that we shouldn't accept any limitation on who might acquire our company or even who might be the next round investor. Now, financial VCs will often also require an approval of a change of control of the company, which includes an acquisition, or may require approval of the next round of investment, issuing a new series of shares with rights superior to theirs, which means the next funding round. And generally, I would be, from a startup perspective, I would be willing to accept that type of deal term from a financial VC because the conditions under which a financial VC is likely to block next round funding or likely to block an acquisition are extremely rare. But this case, we would have to go beyond normal VC terms to be a little more cautious in what rights we give to CVCs versus rights we're giving to financial VCs, because the scenarios in which a CVC might be willing to block a next round funding, for example, from a competitor, or block a sale of the company to a competitor, are not rare and difficult to imagine. They're actually pretty common and easy to imagine. We also want to make sure that the CVC is fairly valuing the company, and this is a pretty tricky problem because oftentimes CVCs, because they are expecting to get financial return and strategic return from startups, they might be willing to reduce their financial return, which they believe is then offset, or they feel is then offset by their strategic return. So then if they add financial and strategic return together, they're getting a decent return. And in being willing to reduce their financial return, this means they're willing to pay a higher valuation, because there's a clear linear relationship between valuation and financial return. If I'm willing to accept a lower return, that means I'm willing to pay a higher valuation, because my return is equal to exit valuation divided by current valuation. So this is one of the reasons that CVCs in many markets, and I do see some of this in our market too, where CVCs have a reputation of overvaluing startups and being willing to pay too high of a valuation, generally because they see strategic value and believe that offsets the lower return that they're willing to accept. It also can come from another source, which is the cost of capital. So the cost of capital for financial VCs can be different than the cost of capital for CVCs. And cost of capital for financial VCs will be higher because their investors expect a uniformly high return, whereas CVCs, who are sourcing their funds from the parent company, which is getting their funds from their shareholders, may be willing to accept lower return because their cost of capital is lower. But in either case, it's not a good idea to get overvalued by a CVC for a startup, even if that seems attractive in the short run, because why? This is going to make it harder for financial VCs to co-invest, and it's also going to make it harder for financial VCs to do follow-on at reasonable increases to the current round valuation. Again, you might think we don't have to worry about that because CVC can do all my follow-on anyway, but then again, we're trapped in the problem where our next round lead investor should not be the same as our previous round lead investor, and definitely we want to make sure that we're not limited to be acquired by our CVC. So I think it's a good idea to get a high valuation as possible, but it should still be a market valuation and not driven by CVC overvaluation because of additive strategic return. And don't mix financial and commercial terms. I talked about this at length already. We should always keep financial and commercial terms separate, and we should make sure that they stand alone on their own and are still attractive on that basis. We should, in some CVC deals, we see too large ownership stakes. So CVCs, especially not the, let's say maybe the more sophisticated CVCs, but the newer CVCs or CVCs that are coming out of traditional business, most of the early CVCs coming from first from telcos, then from banks, then from top corporates, so very sophisticated players. Now we're seeing more and more, which I think is very exciting. We're seeing more and more CVCs coming from traditional businesses, but a lot of the CVCs from traditional businesses, they approach CVC like traditional business investment, where a business acquires even a majority stake or a huge minority stake in investing in small companies. This does not work in venture capital, so we have to be very careful about that. We shouldn't see no single investor in any round of investment should get more than 10 or 20% equity. In some cases, it might climb up to 30, but somewhere around 10 to 20% is a norm. And we saw in a previous slide that CVCs often have some reputation of not being able to lead. And in fact, we should be careful. I would be careful having a CVC lead your deal if they haven't led some deals already. You probably don't want your CVC to be, your deal to be the first deal that the CVC leads. And from the CVC perspective, it's a good idea to co-invest with experienced VCs before they start leading deals. And another major challenge that we see, and definitely we see this in the Thai market, is that the internal legal at Thai corporate are not up to speed or familiar, many are not up to speed or familiar with VC or startup investment deals. And therefore, many of the, I think, problems that we talked about already that can creep into the deal terms, and then even fundamental misunderstandings about how startup and VC deals are supposed to be structured can enter into the mix because the corporate's internal legal team doesn't know how to do VC deals. So it's a very good idea to have, from the CVC side, it's a very good idea to use outside law firm, and one that is already very familiar with VC startup deals, especially in the early deals that the CVC does. And again, from the startup perspective, you want to make sure that both your law firm and the law firm representing the CVC are familiar with startup and VC deals. So CVCs do bring tremendous strengths to the table, and from when assuming that we can get the deal terms that I was talking about in a previous slide, so we don't have any funny deal terms. We do structure the deals in a way that is fair to both sides and doesn't introduce any unfavorable conflicts for the startup. Then the relationship between startup and CVC can be very productive because the parent of the CVC brings to the startup their brand, their resources, market access, customer base, distribution channel, sales force, and most importantly, relevant sector know-how and skills, which no financial VC is going to be able to bring. So this is why I think we shouldn't only think about the dangers of CVC investment, but we should be balanced and recognize the potential benefits. So some of the direct benefits that CVCs can add to startups, the parent can become a customer of the startup, can help distribute their products to the customers. And again, these are, when we start thinking about commercial terms that we want to agree with the CVC, then these are some of the ones that we should focus on. Getting the parent of the CVC as a reference customer, having the parent company sales force resell startup products, providing distribution channels for the startup, helping the startup to quickly scale regionally and globally. the startups, high growth startups in Thailand, almost all have regional or global scaling aspirations. Very difficult to do that on their own, or even with help from a financial VC, where corporate VC, parent of a corporate VC, can definitely help the startup to do that. Platform strategies and clear strategic objectives. And startups we see this play out in the market, where startups with CVC funding are more likely to be acquired than those with only financial VC funding. And this is, again, in the US market, I believe we're going to see this statistic even more in the Thai market. So from the CVC perspective, doing good deals with startups, it's not the topic of our talk tonight. It's not just to be nice. I don't talk to CVCs and say you should do good deals with startups because you want to be a nice guy. Of course you do want to be nice, I believe, but that's not the only reason. The if CVCs try to do one-sided deals with startups, they might be able to do it, but they're going to do deals with all the wrong startups, because this is and then therefore this becomes a totally self-defeating strategy. I'm a CVC. I want to generate financial and strategic return. If I consistently do bad deals with startups, then I'm going to get only the startups that have no better options. Go back to the funding of last resort. I will become the funding of last resort, because why? The best startups have many options for investment. The best startups will be able to appeal to many investors, and they're going to choose their investor. So if CVC tries to have it all, they're going to end up having nothing. Or if they try to have too much, they're going to end up having way too little. So this strategy and approach that I'm talking about in tonight's session, it's not just good for startups. It's good for startups, but at the same time, it's good for CVCs. So CVCs want to work with the best startups, not just the startups that are willing to accept their painful terms. And even if startups in Thailand don't widely recognize how painful these terms are, they're going to recognize in the next couple of years. And as soon as that happens, deal flow is going to collapse for CVCs that are not doing smart deals. So CVCs must bring that differentiated value, just like all VCs. And when only CVC is willing to lead, this can send a bad signal to the market. So this is why, again, CVCs should be able to work with financial VCs. Okay, so that brings me to the end of what I have to say about doing good deals for startups and between CVC and startup. I hope that if you're from a startup or CVC, I hope that gives you food for thought. And I'm happy to answer any and all questions that you might have about my topic tonight, starting now. I was happy to answer any questions that you put in while I was talking, but since there's no question in Q&A and chat, I'll answer questions starting now.
เอาละค่ะตอนนี้นะคะท่านไหนที่มีคำถามอะไรเพิ่มเติมนะคะสามารถที่จะส่งเข้ามาใน Q&A box ได้เลยนะคะในช่วงก่อนหน้านี้ค่ะก็มีท่านที่เข้าร่วมสัมมนานะคะก็ได้ระบุคำถามมาค่ะว่าred flag นะคะที่ควรจะต้องระวังมีอะไรบ้างนะคะซึ่งวันนี้นะคะคุณนักล่าศาสตร์ก็ได้พูดถึงในประเด็นในส่วนของ red flag เนี่ยค่อนข้างเยอะเลยนะคะทั้งในส่วนของตัวที่เป็นให้แยกกันนะคะระหว่าง commercial terms นะคะกับ financial terms นะคะหรือว่าให้ระวังในส่วนของเรื่องstake นะคะการถือหุ้นนะคะหรือในส่วนของ valuation ค่ะเอาละค่ะตอนนี้นะคะก็มีคำถามเข้ามาแล้วนะคะDouglas, there is one question in the Q&A box.
Okay. This is this song. Can everybody see the question, or should I read it?
Okay, the question, I can read the questions นะคะคำถามนะคะตอนนี้นะคะก็หลายๆท่านก็น่าจะได้เห็นในคำถามใน Q&A box ด้วยนะคะ How should you negotiate with CVC that asks to be majority shareholder after 1 year of Incubator or Accelerator program?
So for me, I would say I would not negotiate with a CVC that asked to be majority shareholder after 1 year of Incubator Accelerator program. So I would not even bother to negotiate because that's a totally unreasonable position, and you're never. I don't believe you're going. If this is the whole deal term, I mean, I don't know. Are they investing money or what? But I believe that if the CBC is really making this proposal, their expectation is so unrealistic that you'll never arrive at any sort of win-win solution. So I would just politely decline to negotiate, and I would move on to other investors. Now, one other point that I would like to make here, although it's not specific to CBC, but it can definitely come up during CBC deal negotiations. You should never, ever sell a majority of your company to one shareholder, ever. How often should you do that? Never. And to put it another way, you should never sell more than 50% or less than 100% of your company. So there are no deal should ever be done between 50 and 100%. And in real life, no deal should ever be done with a single shareholder anywhere between 30 and 100%. So meaning, if anybody wants to buy 51% of your company, you tell them they have to buy 100%. We never sell 51% because once you sell 51%, you have sold the company. Once you have given up control of the company, you have effectively sold it, and you sold it for half price because the acquirer only bought 51% instead of 100%, and you will never be able to sell that 49%. And no one, because everyone who buys a large stake in a company buys because they want control, and once somebody else has control, nobody's going to want your 49%. And you have to be very careful because some acquirers, will say, we want to buy 80% and we want you to keep 20% because we want you to have skin in the game. This is just nonsense. This is just a way to get 20% discount from you. So instead of buying 100% of your company, they buy 80% and they leave you with 20% worthless shares that you're never going to be able to sell. And they acquired the company at 20% discount. So never, ever sell more than 20 or 30% of your company to one investor. And 30% is already very high. So somebody said, what percentage is optimum for CBC investment? So there's no difference. I don't believe there's any difference between optimal amount of equity to give to an investor between VC, CBC, or angel. You should always be looking at equity. I believe that a fair amount of equity in a given funding round is somewhere between 10 and 20%. So sometimes a little more. So you might see some deals 25%. You might see some deals a little less, 5%. So I would say a vast majority of equity deals should be between 10 and 20%, with some going as low as 5 and some going as high as 25. But I would, under normal circumstances, you should never do anything outside that range, and you definitely shouldn't do on the high end anything higher than that. Now, over time, investors will acquire more than 20% of your company because you'll do multiple investment rounds. And for example, if you do 3 20% rounds, you'll have sold ultimately more than 50% of the company. But that would be the 3 different investors or 3 different rounds of investors. So that there's nothing wrong with that. But no one of those investors should have more than 10 or 20% stake. It's very tricky, even if you let individual, especially corporate shareholders, get above 30%. Once an individual, one of the single shareholder, and especially a corporate shareholder, gets above 30%, they start to have enough equity that it becomes pretty easy for them to block an acquisition or to exercise some voting control over anything that requires a supermajority vote of the shareholder. So I would be very cautious about that, and we need to be extra cautious when we're dealing with CVCs. Okay, so next question.
Next question is from me. I am just curious if you can give me some example. You talk about separating the commercial terms and the financial terms a few times. So can you give me an example? So of some of the deals where, yeah.
So what would be an example of, so the CVC, the corporate parent wants to do some sort of commercial business with your company. You know, they're going to become a client, a customer. So they're going to be a big customer. They love your product. They want to buy it. They want to use it. But they also want to invest in your company at the same time. So they're a great commercial deal for you. You would do this commercial deal, you know, up and down, you know, like a million times if you had a chance. But in addition, they want to become a shareholder in the company, and then they want some more favorable terms on the commercial side because they're a shareholder in the company, or they want more favorable terms on the shareholding on the investment side because they're a customer. So they try to link these two. You know, if we do this commercial deal, in order for us to do this commercial deal, we want favorable financial terms, or in order to do these financial terms, we want favorable commercial terms. So commercial terms and financial terms should never be linked in that way. You know, they want a better valuation because they're going to give you business, or they want a better price because they're a shareholder. So you should never create a linkage between those two sides. If it's and sometimes, you know, like under some circumstance or in some situations, the commercial deal makes sense, but we don't need them as a shareholder. You know, so we don't want to make them a shareholder just because they promise to be a strategic partner. Okay, there's another question in my Q&A box. Do I have any idea why Thai CVC not being hated as much as the US? Are they generally nice and fair, or are Thai startups too naive? So just to clarify about that, so US CVCs are not uniformly hated, and there are many well-respected US CVCs, Google CVC, Intel CVC, Adobe CVC. So a lot of the tech companies have very well-respected, well-regarded CVCs, and a lot of the the attitudes that I talked about, they're not universally shared, but there is some sentiment. Now, why is this better? But given that, I do believe in the Thai market, it's better, much better. And why is that? I think because we have CVCs are very new in our market, and I think they have not fallen into a lot of the bad habits that US CVCs have. So I think that's good news. You know, we have mostly new CVCs, and they haven't had a chance to make a lot of the mistakes that the bad US CVCs made. So I think, you know, whether Thai CVCs are generally nice and fair, I think, I think it's difficult to, judge a whole group of companies, whether they're nice or fair. I think some people are nice, some people are more nice, some people less nice, some people are fair, some more fair, less fair. But in general, I think we haven't had the type of misbehavior by Thai CVCs that we see in have seen in U.S. CVC market over the last 20 years, and that's one of the reasons that I want to make this point, tonight is I hope that we continue that way. And are Thai startups too naive? I think that this can be part of it. Like there are definitely, I have seen some Thai CVC deals with not good, not favorable terms for startups coming from CVCs, and the Thai startup was not aware of that, as some U.S. startup might be. So hopefully also education of Thai startups will accelerate, and we'll see more sophistication in Thai startups so that they demand better terms from CVCs. Okay, and by the way, I mean, I know a lot of the people that work at many Thai CVCs, and the vast majority of these people, including pretty much everybody I know, are nice and fair. So I think that is something definitely characteristic of our market. Okay. What range of valuation should you expect for a startup after 1 year, considering investment from a CVC for about 1 to 5 million? So I think, again, valuation shouldn't be different between CVC and financial VC. So I think there should be a very tight range of valuation between, if CVCs are properly valuing startups, they should be valuing very similarly to financial VCs. And for a company that's raising between 1 and 5 million, if you think about the range of equity that we talked about, let's say average equity being about 20%, so the valuation should be about 5 times what you're raising. So that would, for 1 to 5 million raised, that would imply valuation 5 to 25 million. But if this is in USD, it's very rare that a 1-year-old startup in Thailand would get a valuation between 5 and 25 million USD. I would guess it's USD because I don't think it's Thai baht. So I would, in order to really answer this question, I would need to know more about that startup. I would say a fair valuation actually a fair valuation, a reasonable valuation for a startup with 1 year in the Thai market, it's probably somewhere between 1 and 3 million US on the valuation. Now, this is assuming the startup is either pre-revenue or very little revenue. So if the startup has a lot of revenue after 1 year, then the valuation would go up. So I think we need a little more information to get a valuation range, but I would say most seed stage investments in Southeast Asia, including Thailand, are valued somewhere between 1 and 3 million, with probably 5 million at the high end. Okay, I think we still have time for a few more questions.
I'm sort of just curious, Douglas.
Yeah.
For the investment term, do you typically see more like equity or convertible terms? Convertible debts. The instrument that are being used.
So in the Thai market, we see a lot more equity than convertible debt or safe notes. There is some peculiarities in Thai company law that make it a little more complicated to do convertible notes than in other markets. So it is possible to do convertible notes and safe notes for startups in Thailand, but we need to make some adjustments to the traditional structure for those investments in order to make them work. So equity investment can work in Thailand similar to other markets. So I think the most common instruments are straight equity investments, although there is increasing use of convertible notes and safe notes, especially for very early stage or small deals.
Okay, and that doesn't differentiate between CVC or VC.
I think that's pretty consistent across CVC and financial VC.
All right, thank Thank you. So there is one more in the chat box.
No, so somebody said, follow up previous valuation question. Where did you get the 5x multiple from, or is it common benchmark? So I wasn't doing a 5x multiple per se. What I was saying was, I'm reading the previous question as saying the company is raising 1 to 5 million. If that's what I understood the question. So the amount of investment I want is 1 to 5 million. And where my 5 came from, I was saying, if you're raising 1 to 5 million and you expect to give up around 20% equity, then your valuation will be 5 times the amount that you're raising, because 5 is 20%, converted into, looking at it backwards, right? If let's say if the equation is, for X investment to equal 20% of the company, what valuation do I need? So that's how I was getting that. I was saying, if the previous question is asking, if I am raising 1 to 5 million, what should my valuation be? Then my answer was, I would expect that you want to give up about 20% equity, and therefore you would be looking at a valuation range around 5 times what you're raising. But that doesn't give you market valuation. So my 1 to 5, 1 to 5 million absolute valuation range is based on in my experience in the market and the deals that I see getting done, and also talking to other investors.
Okay, there is one more question below that. Would you please give examples of potential conflicts or misalignment between CVC and corporate development?
So very, very common conflict or misalignment is where the CVC negotiates that the parent company of the CVC has an intercept right on acquisition. So, or right of first, what I talked about before, ROFO or ROFR on acquisition. So the CVC negotiates with the startup that the parent company of the startup, which is the corporate development side of the startup, will have the first right, somehow either the first right, blocking right, or intercept right for this startup when they get to acquisition. Meaning, if a competitor of the parent company wants to acquire the startup, the parent of the CVC can intercept or can preempt that offer. So that's the most common conflict between, I would say that's the most common conflict between CVC and startup, and that's the most direct and obvious conflict or misalignment between CVC and corporate development. Now, the other way that there might, so that's from the startup perspective. The other way there might be misalignment is when the CVC wants to do it correctly, then they might get some pushback from corporate development. Why are you not getting us favorable acquisition terms for this company? Because our strategy is to buy startups that we invest in. So that misalignment can go, and conflict of interest can go both ways. Now, let's say that if if this is the clear objective of the CVC to feed corporate development, even in that case, I wouldn't make this a contractual right. So what I always advise CVC is it's okay if you want to acquire the startups you invest in. There's nothing wrong with that. But the way that you should do that is by developing your using your venture capital investment in the startup to develop the relationship with the startup so that when it comes time for acquisition, the startup chooses you. Not that you chain the startup to your corporate dev so that they must be acquired by you, or so that you have the decision, you choose whether to acquire them or not. You always can choose. You're never forced to acquire the startup. So the corporate will always have the option to acquire the startup. And you should put yourself into a position where when you exercise your option to acquire the startup agrees voluntarily and wants to be acquired by you because they believe that you're the best acquirer for them, not because you have an intercept right in your shareholder agreement.
Okay, and I think last question for the day, how much equity should you be willing to give to a CVC for an investment of about 3 million Thai baht?
So yeah, again, this is a very difficult question, to answer with just this information because there's a lot of other missing pieces here. But for 3 million Thai baht, it's a very small investment. This is like $100,000. So in the case of a 3 million Thai baht investment, I would advise don't do equity investment. If I was getting a 3 million, if one of our companies was getting 3 million Thai baht investment, I would try to do that investment in the form of a safe note. So a safe note is an instrument that converts into equity at a discount to the next round valuation. So you don't have to, in that case, you don't have to agree with the CBC on a valuation. They give you 3 million Thai baht, you give them a safe note, which enables them to convert that safe note into equity at, for example, 20% discount to the next round valuation. And then how much equity they would get depends on what is the valuation in the next round. So they would get 3 million divided by next round valuation discount or divided by 80% of the next round valuation.